Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling, a special year-end edition, the last Retail Focus podcast of the year and of the decade, as fate would have it. This is our annual countdown show where we talk about our bottom 5 retailers of the year, or really the 5 least successful retailers of the year, and our top 5 most successful retailers of the year, at least in our own eyes. Also, a couple of newsworthy items we'll bring up on today's show, and we'll be joined by Danny Cushion of Cardlytics to discuss some of the bygone retailers of 2019, and more specifically what other retailers can and need to do to capture that market share. A reminder, you can like us, rate us, wherever you do access us, whether that's on Apple Podcasts, whether that's on Spotify, any other podcast delivery service. Also, check us out on Instagram and Twitter at Retail Podcast. So we'll start this show off with a big newsworthy item that actually hit just before Christmas, and this was the worst possible timing, Leighton, as Kroger experienced widespread credit card outages on Christmas Eve.
This is the last thing you would want to hear if you're an executive at any major company, but especially Kroger. You have a lot of people buying groceries, trying to have their baked goods, whatever that may be for the holidays, for their family and friends. So this was sort of a reprise of Target-geddon, I guess we could call it, earlier this year, which happened on a Saturday and Sunday for them. And throughout midday, they had some issues with their point-of-sale systems, and on one of the busiest days of the grocery year, Kroger has a similar thing happen. The incident was actually confirmed around 2 p.m. Eastern time on Christmas Eve, but appeared to affect transactions just prior to that point as well. It seemed to crop up earlier that afternoon and affected their debit and credit card systems. Again, how most people pay, not a good thing. The result was, of course, long lines, abandoned carts of merchandise for the retailer and its affiliates across the country. It appeared to be truly nationwide, affecting all Kroger affiliates that we could find. Reports from Arizona, Colorado, Texas, Kansas, Kentucky, Georgia, and other states were affected. Similar to the Target issue that I just mentioned, the systems first began working intermittently, and then they were back online completely around 3 p.m. Eastern time. So the IT folks over there at Kroger were probably very, very pressed for time there, trying to get everything back online. But when we discussed the issues surrounding Target, there was, of course, some concerns over customers lost and so forth. That's likely less of a concern here. In many markets, Kroger is one of the only choices, but we've also seen in the past that loyalties for groceries are indeed slow to change. Here, the main issue is likely returns and perishables for the company on a day that they were likely short-staffed in the evening and closed, of course, on the 25th of December. So were they able to get merchandise back on the shelves before it spoiled is an important question to ask. The most likely answer is no in some cases, especially given the glut of e-commerce orders these stores were attempting to fulfill at that particular time.
And this all came as Amazon, if you were to look at kind of a competitor or a non-traditional competitor in Amazon, they were reporting record sales. No surprise there, because basically every year they see record sales, but also record numbers of people trying their grocery delivery platform. Amazon said the number of Prime members who tried grocery delivery for the first time during the holiday season increased by over 80%. Additionally, grocery items ordered by Prime members was more than double what it was last year. Meanwhile, in a separate incident for Kroger, a fake Facebook page posting as Kroger claimed that the company would give free groceries to 4 families for an entire year. This got thousands and thousands of shares and comments. Kroger's social media team was forced into work for the second time on Christmas Eve, this coming after the credit card ordeal, having to post that the offer was fake and encouraged people not to fall for the hoax. In any case, given how tight-lipped the company has been about the outage, no formal press release for them, and also tight-lipped about the outage effects, we likely won't hear more about how this impacted the company until their next earnings call, so something at least to look towards, and I'll be anxious to see if they bring it up of their own volition or if it's going to be an analyst that's going to bring that to the forefront. Well, we'll take a break from the news and be joined by Danny Cushion. After this break, she's again the CMO at Cardlytics, and she'll be joining us to talk about retailers capturing market share of failed or closed retailers, distressed retailers, if you will, and the timeline that they have to do so. At the end of each year, we do a retrospective on the retailers we lost that year, kind of an in memoriam. Well, this year we're taking a different approach, It seemed like every earnings call surviving retailers mentioned attempting to take market share from recently closed retailers, though particularly as it pertained to Toys R Us closing in 2018. To discuss some interesting numbers and dynamics surrounding what happens to that left-behind market share, we're pleased to be joined once again on the podcast by Danny Cushion. She's the CMO of Cardlytics. Danny, thanks once again for joining us here on the podcast.
Thanks, Trent. Great to be back.
Now, it seemed like we just talked to you not that long ago, but when this topic hit our radar, we couldn't resist discussing it. Once again, this is data coming from a massive number of card transactions in the U.S. Now let's start with perhaps the most notable number. When a retailer closes, we tend to think that retailers all pick up a little chunk of the business, but that appears to not be the case, correct?
That's right. Yep. So what we see is, and just to back up for a second, what we see in looking at purchase data, since we run cashback rewards programs for banks, really for marketers, it gives folks an ability to reach customers when they're thinking about shopping, thinking about spending money. But for us to be able to power this platform, this like massive marketing platform that we have with banks, we analyze and look at all of this, as you said, transaction data across the U.S. So it's pretty interesting actually to see that as stores close, again, you think that the distribution of how people are shopping would get distributed pretty evenly between whoever's left. It's not actually the case. And there are a couple really important factors that retailers or whomever the remaining brands are should take advantage of. So, as you look at a store closing, only about half of the competitors who remain end up picking up a proportionate share of market spend. And let me give you an example, and I think then we can go from there. Say there are about 5 companies who had equal market share. Say they're shoe brands, vertical specific shoe brands. If one of those goes away, you might think that the share that one shoe brand had would be distributed equally to those 4 other shoe brands. It's not actually the case. Actually, only about half of the brands there are picking up the share. And what's actually happening is it's not that shoe spend is going away. It's that it is actually often leaving the vertical specific stores quickly to go to multi-line retailers. And there are definitely some things that retailers can be doing to capture the share, but it's quite specific, and it does actually start with knowing where to spend actually go so that you can act on it.
Now, I wanted to kind of go off of that a little bit because I think there are some equally interesting numbers about customers actually rethinking their spend in that entire vertical when retailers are going out of business. I was wondering if you could maybe discuss this concept a little bit further and using that shoe store example, kind of take that a little bit further as well.
Sure. So I think the first thing, and again, the data that I'm sharing here is aggregated across all verticals. It does actually differ a bit by category, and the factor that goes into that really has to do a lot with purchase frequency. And so if you're talking about a grocery store versus a mattress store, it's a little bit different, but the numbers that we're looking at here are aggregated across verticals. But what we see is that, and we'll call them distressed brands, right? So the brands who are actually going out of business or going bankrupt or closing stores, 20% of a distressed brand's customers do not come back to vertical specific stores when those stores close. And I'll say that another way. So say we'll pick on Payless here. So say Payless closes, 20% of Payless customers don't come back to go shop for shoes at specifically shoe stores. Their spend often will go elsewhere, and often it's multi-line. So while there's an opportunity for shoe stores specifically to pick up spend as Payless stores close, so DSW has a great opportunity, Zappos has a great opportunity, so too do fashion retailers who have shoe lines, so too do multi-line retailers who are selling shoes. everybody has a potential bite at the apple. You don't stop buying shoes. Consumers don't stop buying shoes. But 20% of those brands are actually leaving vertical-specific stores. So what's interesting then is as you look at what do you actually need to do from a retailer's perspective to make sure that you're actually picking up share. The other example I like to give actually is look at when Toys R Us closed. I'm a mom of 3. I didn't stop buying toys. I just had to really quickly try to figure out how am I going to get what I need to get or what I would like to get across all of the options in the universe of people who sell toys. So one of the things that's really interesting is how fast you need to figure out how to go to market to pick up spend from people who had been shopping at a distressed retailer. So what we actually see, and since the targeting that we do in our native ad platform in banks is all based on past purchase history, so a lot of our clients are finding that if they can look at people who historically had spent pretty regularly at a distressed retailer, when that retailer closes stores or starts to close stores, if they can actively target those shoppers very fast, they can be very, very productive in capturing share. And I'll give you some numbers. Within the first month of a store closing, about 9% of that category spend goes away to multi-line. Within 3 months is 27%. Within 6 months, 30% of that spend goes away. And honestly, if you're looking at, sticking with a shoe store example, if you're looking at a shoe brand who's trying to pick up share, if you don't act fast and start targeting, and honestly, maybe even before stores are closing, thinking about conquesting stores who might be in trouble, it's a little bit of a vulture strategy, but honestly, it's really a competitive conquesting and thinking about how do you shift share that it's perhaps likely to change anyway. You have to do it fast. If you wait, you might actually lose consumer spend to multi-line, and then it's a really hard uphill battle to get it back into a vertical-specific store after that.
And you mentioned that, but it's just reality. If you don't get that customer, someone else will. And of course, we talk all the time about the cost of the new customer being the most expensive customer. Now, I wanted to go back to kind of the beginning of your last answer here. We've seen retailers from a wide variety of verticals close down. Toys R Us, of course, back in 2018. Payless Shoe Source, which again was something that's been mentioned. Shopko and General Merchandise, Gymboree and Children's Apparel. In your data, did you find that customers reacted differently depending on the segment? I know, for example, and you kind of alluded to this, but general merchandise like Shopko is probably going to be a little bit more differently affected.
Yeah, I think that's interesting, and you nailed it at the end. I think if you look at categories that are more of a necessity, like grocery, sometimes even pet supplies sort of has these kinds of factors where people are going in and they are, well, in essence, they're buying food and needed items for their pets. They do act a little bit differently. We do find that customers, say, shopping grocery or shopping pet supplies, might be a little less likely to jump to multi-line and stay within pet-specific vertical stores if somebody is closing down. Now, the caveat to that is there are a lot of multi-line retailers who are being very, very, very smart right now about their grocery strategies, their pet supply strategies, because they see the opportunity. So I think that sort of phenomenon might last for a little while, but as the marketplace changes and the multi-line retailers like Target, like Walmart, like Amazon are having a deeper vertical breadth of expertise, there is a flattening happening across all categories. There's not as much of a difference from somebody, say, shoes or high-end fashion like a Barney's. It does end up sort of flattening it out across verticals, and the data ends up looking more similar over time.
Now, you mentioned this, and I wanted to unpack it a little bit further, but there's a bit of a discrepancy in the data between some stores of a distressed retailer closing and all stores of a distressed retailer closing. What were some of the differences there once you got to parse that out?
No, that's a great point, actually, and I think the number that I mentioned before, which is 20% of a distressed brand's customers don't come back to vertical-specific stores, that's actually when some of its stores close. It's actually a higher number when all of the stores close. So again, a distressed retailer closes, some of its stores, 20% of the shoppers there might leave the vertical specific stores altogether and go to multi-line. When all of their stores close, it actually goes up to 45%. So again, think about, we'll stick with Payless. All of the Payless stores closing over time means 45% of the people that had been shopping Payless are going to buy shoes outside of a shoe-specific retailer. So there is actually a little bit of a difference. And again, this is where the smart brands and the ones who are doing well can take advantage of acting early because the spend is likely to shift. It sort of tracks really nicely with what we see with how quickly spend goes away as some stores close, as all stores close. The ones who are proactively marketing to customers or potential switchers at other distressed retailers are the ones who are going to get the lion's share of spend and keep them in that vertical. Because again, once they go outside of shopping at a vertical specific outlet, it is a lot harder to get them long term.
Something else that you mentioned that I wanted to dig a little bit further in is you mentioned obviously time is of the essence when a retailer closes. You've got a finite amount of time to pick up that new market share. And I'm kind of wondering, based on the data that you're seeing, is there an ideal timeline for retailers to come in and scoop that up, maybe even before a distressed retailer closes those stores? Obviously, you don't want to be putting dirt on an early grave or anything, but what did you notice as you were looking this over about retailers potentially being able to take some of that market share while a distressed retailer was still in business?
I'll answer this as diplomatically and delicately as I can. That's sort of marketing. You're always trying to steal share from other competitors, and where you see there's an opportunity to get someone to come and buy at your brand versus someone else's, that's sort of an ongoing state. Now, whether you're proactively going after specific folks who may have likely switchers, it is actually before stores are going away. But I think once brands actually close, then that is the perfect time to really ratchet up. It's a tough one because, again, you're always trying to drive switchers as a marketer. And really what you want to be doing is driving brand affinity and loyalty for your own brand anyway, well before others are losing. So you want yourself to be doing it early so that folks have already perhaps made one purchase with you or are perhaps ready to consider you. You don't want to be starting your brand awareness the day that a toy store closes and you're a new toy store. That's a bit too late. You can really, turn up the ratchet at that point, but you really should be starting before. Because honestly, Trent, the other thing that matters here is the customers who are acquired after a store closing are actually more valuable too. So they end up, if you look at, and we look at the purchase data, if you end up looking at what a customer spends, if you've acquired them from a competitor who is closed, they actually end up spending 30% more than customers who are acquired just through your normal course of business. And so you have people who have a high propensity to buy in a category already. So it actually ends up that they are not only looking to spend more, so they're actually 3 to 5 times more likely to return than those who didn't shop in that period. So just a couple numbers, to pile on top of it. You should be doing it for a while anyway and building up your brand affinity. But if you are not going after customers from a distressed store, you actually are potentially losing out on a lot of headroom because they already have a pretty good propensity to buy in vertical specific stores already. And you are leaving a lot of money on the table if you're not doing that kind of conquesting activity.
And amazing numbers there as far as customers converting from those distressed brands. Now, I wanted to kind of end on this question, if you will. I know Cardlytics at its core is a data company, but you also do a pretty decent amount of consulting and assisting retailers based around that data. If there's a retailer listening to this podcast and they have a distressed brand in their space, what would be the advice that you would give to that non-distressed brand as far as going and getting that market share early on?
I actually think for us, so we sort of have a saying in the walls here at Cardlytics, it all starts with what you know. We are a data company. We crunch some massive data, but we don't do it for data's sake, and we don't sell data. We use it so that it's actionable by running ads within banks where people are really, really likely to consider. And again, they take the form of cashback offers, so we've paid a lot of money back to consumers for taking a specific purchase action, which actually puts money back in their pockets. From a brand's perspective, it all starts with what you know. So if you don't have a really good handle on where your potential either current customers or next customers might be spending outside of your own walls, a lot of brands have a very good idea of what people are shopping with them, but have limited sight of where people are shopping elsewhere. You must, at the very basic level, know where else are people shopping And from there, you can get a pretty good handle on, all right, market intel, where are competitors struggling, where might there be an opportunity to capture share and shift some spend to yourself by driving campaigns sooner rather than later. And that's a lot of what we do to what you mentioned with our marketing clients is we work with them year-round to try to establish how are they actually going to drive their business and reach people who have a high propensity to buy with their brand, again, through ads in a very large and fraud-free advertising channel, which is Cardlytics.
Well, as you alluded to earlier, it all comes down to marketing, and that's kind of what marketing is at its very essence, at its very core. Well, once again, Danny Cushion, the CMO of Cardlytics, thank you so much for joining us again on the Retail Focus podcast.
Great. Thank you. Happy holidays.
All right. Well, we appreciate Danny for joining us once again on the podcast, and it's time to get to our annual ranking of retailers. Now, it was a difficult year to come up with the ranking, probably the most difficult that we've seen in the years since we've been doing this. And this is due to a number of factors. First, retailers saw incremental gains and losses in 2019 rather than massive jumps or leaps back. And then also second, many retailers, especially those in higher end shopping centers or with robust e-commerce sites, saw gains across the board. So it was kind of difficult, honestly, to find struggling retailers outside of apparel and a few specialty segments based on our criteria. You've got the department stores there, you've got a few others, but kind of difficult to find those. And let's talk about that criteria, by the way, just to kind of clarify things, because this comes up every year. People kind of ask questions, what about a bankrupt retailer or a closed retailer? We're looking at only retailers who survived the year. Otherwise, the list of worst or least productive retailers would just read as all the closed retailers in this last year. So as such, you won't see the likes of who we brought up in the interview with Danny, so Payless, Shopko. You won't see Dress Barn on there, as Ascena Retail Group exited that concept this year, or any other of the failed retailers that closed completely. Overall, we're going to assess retailers on a mix of same-store sales, overall revenue growth or shrinkage, internal initiatives completed or not completed, and store count movements as well. Now, it's an inexact science. It's very subjective. If you feel we missed someone, feel free, let us know on social media. In all likelihood, we didn't catch all the retailing stories, especially the good ones this year. And honestly, the top 5 was a lot more difficult to kind of trim down than the bottom 5. Let's talk about the bottom 5 first, and we'll go through these a little bit more quickly than we'll go through the top 5. Honorable mentions, we thought seriously about including Macy's after their latest call, but it was enough of an up and down, now mostly down year for them, but enough of an up and down year for them that they just missed the cut. Maurice's was also a candidate, but honestly, we didn't see a lot of numbers from the second half of the year after going mostly private, essentially, so that kept us from including them. Finally, Bed Bath & Beyond was actually our last cut. We wanted to find room for them on the list, but they managed to escape. Still never a good sign when a company sheds a CEO and most of their leadership group in 1 year. They would for sure be 6th if our list had a 6th, but it doesn't, and we start with number 5 and Leighton.
Number 5 on our list, JCPenney, a retailer that we've talked about a few times on the podcast in 2019, and a retailer that I should fully disclose, I was actually an investor in this company. I had several shares lined up from around 2.5 years ago, but the company did not turn itself around, and that is why they are on this list. So congratulations, JCPenney, or maybe not congratulations, I guess. You'll end up on this list when you continue to see many cyclical issues that have pretty much plagued you in the last several years, JCPenney. Most notably, inventory control or lack thereof continues to hamper margins and drive customers towards clearance activity. And I actually spoke recently on the podcast about a JCPenney I visited where an entire section of the first floor of this JCPenney basically looked like a TJ Maxx or a Ross. It was just nothing but clearance activity. Everything is in disarray, very disorganized, not a good sign. Inventory did improve by the end of the year for JCPenney, although it did come at a cost in terms of top-line revenue. For the year as a whole, net losses were once again a major story for news outlets for JCPenney, but we were mostly disappointed with their same-store sales. Even if you go by the adjusted numbers, and we're talking about adjusted numbers for discounting of several business verticals, we're talking about appliances, home furnishings, Their comps decreased 6.6% in their most recent quarter. Not a good sign. They did end the calendar year with about $1.7 billion in liquidity, which is crucial since they are continuing to lose around $100 million per quarter. And by the way, they have a truckload of long-term debt on the balance sheet. If you do want to find a bright spot for JCPenney, their income from credit services does continue to increase at a rapid rate. For their most recent quarter, up around $116 million in terms of credit services revenue from $80 million last year. Even so, many people think that this will be the next big brand to go. We're talking about dead malls, dying malls. JCPenney certainly in a number now of underperforming malls that have not completely shuttered. However, we would like to take maybe a broader picture and look at Jill Soltau, who is still being given a chance. She just came on board as the new CEO, so we're looking at a little bit of optimism for their immediate future.
Let's move on to number 4, and it's Justice, the teen apparel retailer. Now, interestingly enough, most of Ascena Retail Group's brands have stabilized somewhat after the sale of Maurice's and the planned conclusion, as we talked about, of the Dress Barn brand. Lane Bryant, for example, saw comp sales of a positive 2% in the most recent quarter, and Taylor and Loft were a combined negative 2%. Not bad overall, considering their past. However, Justice has been quickly going in the other direction. In their latest quarter, which is the first quarter of their fiscal year 2020, Justice saw negative 6% comp sales movement. Additionally, comps were down by about the same amount over the prior 2 quarters. They were also a drag on Ascena's overall finances as the company blamed high promotional activity in that kids fashion segment for a decrease on the gross margin front. In the last 2 quarters, kids fashion has shown the greatest operating loss of any division for the company. In the 4th quarter of fiscal year 2019 alone, Justice was in fact the only division to show an operating loss. And it's interesting because Justice was one of their better performing brands around 4 years ago. However, as was referenced in our interview earlier, it doesn't seem as though they were able to properly capitalize on Gymboree's exit. Although customers of the 2 brands only have a partial correlation, there's only a little bit there in the middle of the Venn diagram. Still, they appear to be struggling against multi-line retailers to battle for kids' fashion. And of course, a lot of people remember a couple of years ago, Justice came under fire for some materials that were in the cosmetics there being sold at the store. So again, some of the accessories coming under fire there. Even still, Ascena does remain wedded to the concept, and so it's important to note that they opened a net of 2 new stores towards the end of the calendar year. Justice actually represents their largest division by store count, but on a per-store basis, they bring in much less than nearly every other brand, and that's owing in part to the lower price points at Justice versus their other brands. But again, when you look at the real estate that Justice oftentimes will find itself in, these are some high rent areas usually. So long term, Ascena's got to determine what's going to make this brand successful because they've invested a lot of money in these rents.
Number 3 on our list is Yankee Candle. Although they just opened a new R&D facility, Yankee Candle continues to lose market share to Bath & Body Works and specialty fragrance retailer. Part of this downward trend started several years ago when Yankee Candle failed to move from predominantly paraffin wax-based lines, while other candle makers switched to soy or other waxes. Their parent company, Newell Brands, has been struggling as a whole. Yankee Candle is in their home and outdoor living segment. This segment took a blow financially this year as the company decided to shutter 72 underperforming Yankee Candle stores over the first 9 months in 2019. Making matters worse is that Yankee Candle has a number of locations in those B- and C-class malls that have been struggling so much as of late. Nothing looks good for the company numerically. Gross margin is down. Selling, general, and administrative expenses as a percentage of sales was actually up in the most recent quarter. And the company posted a loss as a percentage of sales of 30.4% in the most recent quarter, much of it coming from the downed Yankee Candle outlets. The home and outdoor living segment had an operating margin of negative 25%, believe it or not, in the most recent quarter as well. Nothing looking good on the number side of things. As such, the company is looking to move its home fragrance division away from being centered around Yankee Candle. Basically, leadership has indicated that they feel the brand is not in good shape, but they are seeing growth in other areas of home fragrance in their wholesale work. That said, it looks like a real possibility, a very real possibility, that Yankee Candle stores will cease to exist in the near future. Leadership said on the most recent call to expect more store closures in the new year, and they've actually been trying to avoid closing stores just before the holiday. So it's sort of a stern warning to those stores that have been underperforming for some time. Additionally, we will see likely the departure from the Yankee Candle brand happen slowly despite their new R&D center. As an example, they are now seeing only slightly positive e-commerce growth as their competitors grow between 20 and 30% yearly.
From one traditional mall retailer to another, in Victoria's Secret, they occupy the number 2 spot on our least performing retailers here this last year. Things have turned even worse for them this year versus last year. Last year, I think we both acknowledged the company as a whole in L Brands was kind of neutral, but Victoria's Secret in particular headed in a negative direction. We heard word that maybe things looking good in the last quarter of 2018. There was kind of a positive start to this year following a decent holiday in 2018, but things have kind of cratered since then. Brick and mortar comp sales for Victoria's Secret are down 8% through the first 3 quarters of the year. Last year, e-commerce sales were at least enough to keep the brand afloat. Not so this year. Victoria's Secret's direct sales were actually down in the 3rd quarter of 2019. Year-to-date direct or e-commerce sales are basically even, up just 0.01% through the first 3 months of the year, not getting it done when, as Leighton said, a lot of specialty retailers seeing increases at the very least in double digits. This all has been accompanied by 34 net store closures from February to November of this year. Their Pink Extensions growth has also slowed, with just 2 net new stores having been opened since the beginning of the year there. Operating income for the Victoria's Secret division of L Brands has been down around 60% to this point this year. Those are massive declines in operating income, and no matter which buttons they've pushed, seems like they've always been the wrong ones. Merchandise mix has come under fire constantly. We've had several interview guests actually call them out for a poor merchandise mix that is maybe out of touch with what today's consumers are wanting. They've wasted a lot of effort going back and forth between their couponing and direct mail marketing programs, whether to have them or not. Reintroducing swimwear this year, that's a positive step, but one that should never have had to have been made. Again, they should not have done away with swimwear. A lot of people critical of the decision then. It looks even sillier now. Looks like it just eroded more market share for them. So for Victoria's Secret, you kind of wonder how L Brands is going to get out of this, and considering that Bath & Body Works is a more successful brand and they are hemorrhaging cash on Victoria's Secret right now, you kind of wonder about the brand's overall future and whether it's got a future under the L Brands banners.
Number 1 on our list of least performing retailers for 2019 is Transform Holdco, basically an entity that was spun off through the assets for Sears Holdings Corporation after they filed bankruptcy. And this happened on February 11th, 2019. This company, Trent, is spun off trying to create an add value for the company, which now holds Sears hometown stores, Sears branded stores, and of course, Kmart's. However, nothing good has happened after this transformation. Transform Holdco is not looking good at all. As in February of 2019, when they were actually created, they had 425 stores. Now, through a series of 4 different closing rounds, closing Kmart's and Sears throughout the country, they're slated to only have 182, and this was without hometown stores, so only Sears banners and Kmart's banners in February of 2020. Again, 182 stores. Things have not gone well at all. Despite spinning off assets to try to create more value, try to create cash for the company to run, they still have a lot of debt repayment that is due. And if you look, Trent, the Chapter 11 bankruptcy protection on October 15, 2018 has actually done little to steer the company in the right direction, namely because they don't have any new strategies in place to turn the company around. Merchandising is stale. A lot of the suppliers no longer trust Sears or Kmart to pay on time, which is always a problem, and therefore a lot of suppliers have bowed out from selling merchandise to Sears or Kmart. So a lot of problems happening with the fall of Sears and Kmart over the past several years, but now it's looking as though we may not even have a Transform Holdco with a retail business in 2021. We remain optimistic that Transform Holdco will at least have some retail presence into 2021 and years beyond that, but as of right now, management and the overall structure of the company just does not seem robust enough to sustain another year in stem losses.
Yeah, and again, as you kind of mentioned, it comes down to sourcing, and not only if companies are willing to give you credit, that's fine, but you're looking at supplying goods for 180 full-line stores throughout the country, and honestly, that's getting to be a point where you're not going to be feasibly operating those stores here in the near future, especially since we know they're closing a lot of the higher performing locations throughout the country. So turning to the positive now, let's look at the top 5 honorable mentions as we'll start here. It was tempting for us to include Stage despite the widespread full price store closures simply because of their execution on the Gordman's vertical. It would not be at all surprising to see Gordman's on this list next year, with double-digit same-store sales increases for most of this past year. But again, smaller sample size. We want to kind of see if they can keep this up for another year before anointing them into the list. Still, we applaud Stage for this wholesale change of their business model. Cato, for those that hadn't noticed, turned things around dramatically earlier this year, seeing massive same-store sales growth. In fact, their stock has popped nearly 50% since June. They've also seen about the best internal growth of any apparel retailer out there this year. However, they started from such a low point that it was difficult for us to fit them on the list. Begrudgingly, we have to mention that Lululemon had a standout year, despite the fact that we're not great fans of their leadership. And then we get to the final cuts. Walmart, who has been included on the list in years past, just misses it this year. They began to see a much higher margin on online sales, despite negative PR from that division earlier in the year. And of course, their brick and mortar same-store sales increases were stellar once again. They were the second to final cut on the list, and the final cut was Target, actually, who saw much of the same success as Walmart did. And I think if you look at this list and you say, hey, Trent, Leighton, I think you got it wrong, I think those two retailers should be in the top 5, probably am not going to argue with you a whole lot. It was just kind of tough to whittle it down to 5. But they did, Target, a phenomenal job of building out in-store fulfillment of digital orders this last year. Also, they absolutely crushed a private label release, simplifying things for consumable shoppers. And speaking of consumables, they showed signs of finally getting food and beverage under control and reducing shrink. Other retailers under consideration were Amazon, left them off because they're still struggling to build those margins, took a step back on the margin front late this year. Home Depot started to slip late in the year as well. And actually Goodwill, who is a retailer we don't spend a lot of time talking about, but they were certainly in contention, would probably fit into the top 10. They really took advantage of the secondhand retail movement and building out store count. Interesting because it's a not-for-profit retailer, but they still killed it during this last year and saw a growth in their overall store count. Now we get to our top 5. And number 5 on this list, I don't mean to sound clickbaity, but it might surprise you. It's Ace Hardware. We don't cover Ace Hardware a lot on the show, so it surprised us even when we kind of laid everything out and saw Ace Hardware sitting at number 5. But when we sat down and looked at everything they accomplished this year, it was really quite a remarkable 52 weeks for the retailer slash franchisor slash cooperative, especially considering they aren't a massive monolith with these huge locations like Home Depot, Lowe's, or Menards. The fact that they had this kind of success with smaller square footage stores on average speaks to that recent trend we're seeing towards lower square footage in retail in general. Now let's talk about their year in review from an initiative standpoint. Very busy year for Ace. The most impressive thing they did, arguably, was acquire Handyman Matters. That's a company, Handyman Matters, and step into services franchising as well. This was actually done just a few months ago in September of this year. Handyman Matters is a franchisor of home improvement services with 57 current franchisees. Now, it doesn't take a genius to figure out how that's connected with Ace's core business model. This acquisition should allow Ace more flexibility and the ability to offer services that complement their goods, similar to what Home Depot, Lowe's, and Lumber Liquidators has started to do recently. full integration for the deal, by the way, slated for early 2020. Another major initiative was the acquisition of more member stores. In the past, Ace's corporate-owned stores have carried the Westlake tag, with the other stores being independently owned by members of the co-op, but they've slowly been acquiring a few more member stores to add to their internal holdings. Among other things, they also successfully built out their e-commerce platform further to the point where they're seeing growth there. We'll talk about that in a second. Added on to a distribution center in Dallas, added a ton of stores, including 11 stores in former Orchard Supply Hardware locations in California. They struck a new deal with Benjamin Moore to expand their paint selection. They launched new e-commerce delivery services, and they won a ton of corporate awards. So it's not just us, but other firms that are saying, hey, Ace is a company to be reckoned with. Forbes named the company one of America's best employers in April. They were also named a top workplace by the Chicago Tribune. Additionally, they scored a number 5 ranking in the Franchise Times' annual Top 200. They are the only non-food or hotel outlet in the top 10. Circle K, by the way, was 14th on the list. So for Ace to be where they're at amongst the likes of McDonald's and Burger King and the like, that is huge for this retail company. I actually talked also with a manager of a Midwest distribution center this year as well, and he suggested that there were plans in the works to build out their distribution and fulfillment even further to keep up with demand. The individual stores are demanding more from the distribution centers, and they're opening more stores as a whole. Things positioned the correct way here for Ace. Now, as far as the numbers are concerned, their sales numbers did increase as the year went on, but same-store sales, honestly, nothing special. Very much in line with the likes of Home Depot and Lowe's. U.S. same-store sales were up 3.4% in the most recent quarter, which was the third quarter of 2019. They were up 3.9% in the first quarter of the year as well. However, e-commerce sales killed it, especially in the second half of the calendar year. They were up 55% in the first quarter, which is great. 55% increase year over year. But they accelerated to being up a whopping 81% year over year in the third quarter. An 81% e-commerce jump. And it's not as though Ace had no e-commerce site last year. It's just a matter of the improvements in the delivery programs they've installed, managing to run traffic. Their net income in their most recent quarter was a record as well, $60.5 million. That, by the way, 66.7% higher than their net income last year. So you're noticing a trend. Not only are they bringing in more sales, but they are much more profitable on their sales. And as if sales from continuing operations weren't impressive enough, mention all the stores they've added. They've added 80 net new stores in the past year and have consistently seen way more stores open than agreements canceled. They call it cancellation of agreements because it is, at its root, a co-op. All of this adds up to a very successful year for Ace. Between the numbers, between the initiatives, they show no signs of slowing down. We're going to stop short of saying that people would rather shop at Ace than Home Depot or Lowe's because those two companies have seen success in their own right. But many are apparently enjoying that convenience that smaller store size offers. And with their e-commerce site slowly building out, co-op members can direct customers online if they can't find a product locally. Maybe will decrease some of the clutter that you see in some of the local Ace stores. Like I said, all of it, very successful year for Ace, and we welcome them to our top 5 for the first time ever.
Number 4 on our list is Publix, the lone grocery store on our list. The employee-owned Publix showed sales better than industry average in 2019, all while executing on their plans to stake claim further north than their Florida base. Earnings release after earnings release, Trent. Their internal share price continues to grow, now at $47 a share, when it was around $30 a share just a few years ago, including a $3 jump in the most recent quarter. We should note that Publix's stock, by the way, is not publicly traded, but available to officers and employees. If you look at their year in review, they continue to expand their Green Wise market concept with an announcement of a handful of location openings. Currently, they have 4 of these markets open with plans to hit double digits by the end of 2020. They have around 12 locations currently announced thus far. Their first location opened in Tallahassee in October of 2018. This is their response basically to Whole Foods, but more ready-to-drink in-store coffee, beer, and wine selections. They also continue their expansion outward. We've made much of their expansion north, but they are also moving west. They acquired some leases in Western Market to further their entrance into Alabama. In the fourth quarter alone, they opened 12 stores ranging from 21,000 square feet to 49,000 square feet. Additionally, the areas in which the stores were opened were diverse. One in Nashville, a handful in Alabama, and a significant number still in their Florida wheelhouse. Their entry into the Richmond grocery market has also seemingly been well received. I know, Trent, you recently visited a Publix there in August, and it was packed, while the nearby Food Lion looked pretty much like a ghost town. They now have 46 stores in Tennessee, 15 in Virginia, and they continue to spread up to 1,241 locations overall as they continue to expand by about 5% in store count each year. If you dig just a little bit deeper into the numbers, you can make a case actually for Publix to be on the list based on this quarter alone, with a stellar earnings call in a segment that doesn't often see a lot of fluctuation. And you see their comp sales increased 3.7% over last year's third quarter. Going beyond the most recent quarter, their comps increased a whopping 4.8% in the second quarter, although this saw favorable impact from Easter shift. Because of Easter shift, comps were adjusted for a 1.9% increase in the first quarter. As far as overall revenues were concerned, they increased as a function of that unit expansion we've been talking about and those same-store sales gains. For the third quarter, they came in at $9.3 billion, which was a 6.3% increase from a year ago. By the by, they actually saw an increase of about 0.9% due to the impacts of Hurricane Dorian, something we should certainly keep in mind the next time we discuss hurricane-related retail impacts. Some retailers benefit from this, some retailers do not. Overall revenues were $9.3 billion for the second quarter as well, an increase of 6.8% year over year. Despite the Easter shift that I previously mentioned, their revenues for the first quarter were up 4.3% year over year. If there's one spot that you could perhaps be critical of Publix, it would be their net earnings. If you look at just their most recent quarter, net earnings were down by about 15%. However, this is more drastic than the situation actually is, and they had to include a negative impact from net unrealized losses on equity securities, a result of them basically not being publicly traded. So excluding this impact, earnings per share actually increased slightly, just over 1%. Earlier in the year, though, profitability was solid, with an increase in earnings per share of 11.6, excluding net unrealized gains in the second quarter, otherwise known as NUG, and an increase of 5.3% in the first quarter. Granted, their net earnings in the first quarter were up an insane 44.2% year over year. An increase in outstanding shares resulted in a bit of dilution on the earnings per share front. Overall, though, Trent, it is clear that Publix is well on their way to winning the southeastern U.S. grocery battle going on right now. Their new locations seem to be well received, and their expansion northward, on the whole, seems to be going better than Wegmans' expansion southward. As far as their 2020 is concerned, we would expect a lot more of this expansion mindset from the grocer. One thing that we are watching very closely, will they expand their manufacturing and distribution network? Currently, their furthest north DCs are in Alabama and in Georgia. Are there plans for a North Carolina or Tennessee facility in the near future? And where they open the next facility might give us a clue as to their future plans for even more growth into those states.
We move on to number 3 on our list of most successful retailers for 2019, and it's Dollar General. Now, you can watch as many negative pieces as you want about Dollar General. Looking at you, CBS. The reality is they are killing it. And I just want to backtrack a quick note on the whole chasing local grocers out thing and creating food deserts thing that is cropped up. Honestly, this is a complex issue. There's a lot of moving parts there. Those that are in retail, of course, know this. It's not as simplistic as it was made to seem on that national news story, but many rural Dollar General locations are actually opening where local grocers have already closed. I could count you dozens, at least in my area, that are doing so. Additionally, in areas that are food deserts, Dollar General's actually made a commitment to stocking more fresh food and produce. Leighton and I know this fairly intimately, so not necessarily the enemy that they're made out to seem in this case. Anyhow, let's discuss their initiatives that they were able to capitalize on for 2019. Basically, when it comes to Dollar General, it all comes down to their expansion plans, and they continued unfettered. They opened a massive number of locations in a variety of both urban and rural locales. Over the last 12 months, they've opened a total of 724 net new stores. Just keep that in mind when someone comes up to you and talks about all the stores that are closing. They actually peaked above the 16,000 store mark for the first time. Additionally, they completed a number of remodels that's made it easier for certain locations to dive headfirst into more consumable sales. Beyond this, they've made a specific effort to expand seasonal sales as well. That has paid off in same-store sales numbers, and they've been able to do all of this basically without an e-commerce presence. Let's talk about their numbers. To date in the fiscal year, Dollar General's numbers have been stellar. Now, you're not going to see the double-digit same-store sales increases because this is such a mature retailer. Again, they started the year with over 15,000 stores. Same-store sales have increased by 4.1% to date over fiscal 2018. This is boosted by same-store sales increases of 4.6% in the most recent quarter, well outpacing inflation. Again, for a mature retailer like this to be sporting growth numbers on a same-store sales basis is insane. And they're doing it largely in consumables and seasonal too, those two areas that they are so focused on, but also areas where inflation has been less pronounced than others. Net sales for Dollar General up 8.5% to this point in the year over last, supported by those same-store sales increases and, of course, that increase in store count. Operating profit, meanwhile, has increased 7% to date. Now, in terms of looking forward, there might be some concerns over rising freight costs and higher shrink, both of which actually started to impact Dollar General this year. In particular, freight costs might be an issue given their widespread store base, their need to distribute to so many rural and far-flung areas. However, to this point, they've actually been able to find margins in other ways, most notably by reducing markdowns in store. And actually, shrink has become a little bit of a bigger issue for them. They've been able to overcome that and continue to increase their margins. Dollar General, again, you talk about a retailer firing on all cylinders. Dollar General fits that bill. And finally, they project to keep opening stores at a breakneck pace next year. They're going to increase store openings. 1,000 new store openings next year are planned. 1,500 remodels and 80 relocations. Would not be a surprise whatsoever to see them on the list next year.
We are down to number 2, and this is a company that we actually talked about in the 5 worst retailers in 2019, but it was a company that actually is a direct competitor to Bath & Body Works. Bath & Body Works coming in at number 2 for a variety of reasons. For the second consecutive year, Bath & Body Works ends up on this exact list, while Victoria's Secret ends up on the bottom 5 list. All the things that were going wrong for Victoria's Secret pretty much going right for Bath & Body Works, and Bath & Body has been able to leverage their diverse store base and growing e-commerce site to experience continued growth in 2019. And if you look, Trent, it's really no secret as to why they've had so much success in this last year. You look at the initiatives, this section is going to be short and sweet, but Bath & Body Works has spent considerable time focusing on their e-commerce site this year, and this time, this effort, it is all paid off with increasing e-commerce sales that outpace most other retailers in this specialty segment. Additionally, unlike their retail cousin, Victoria's Secret, we're looking at you, they have been steadily growing store count. And you look, Trent, in the last 9 months, they've opened 23 net new company-owned stores, almost unheard of for a primarily mall or strip center-based retailer. They've continued to invest in licensed stores as well, with 17 new licensed stores opening this year to date. Their developments in sub-brands and additional scents have also paid off as their product line is able to stave off stagnation. This is something we see in the numbers and continue to see. Statistically, they are the number 1 home fragrance retailer in the United States. If you dig a little bit deeper into those numbers, Trent, you'll see that L Brands does a grand favor for us by breaking down those e-commerce and brick and mortar sales for comp sales. And you look, Bath & Body Works has seen a 10% total comp sales increase through their third quarter of 2019. There has been a remarkable consistency from quarter to quarter in this particular area. On the brick and mortar front exclusively, they're doing very well as well. They've seen a 5% increase in same-store sales year to date. This is even more remarkable when you consider that their brick and mortar same-store sales increases were high single digits last year. So we talk about the stack, and we talk about how a lot of times you don't achieve a solid 2-year stack because you're really competing against yourself. If you've had a good run like Bath & Body Works, a lot of people think that, oh, maybe there's going to be stagnation. No, not the case in 2019. So while you could say that their growth is slowing, this is a bit disingenuous overall as they've stacked massive brick and mortar growth up the last 4 years now. Their direct, and by the way, mostly e-commerce sales have increased 32.1% year to date over 2018. Net sales for Bath & Body Works are up a whopping 11.8% year to date, benefiting from all facets. Their operating income has actually increased by a similar margin too, up 10% for the most recent quarter, indicating a number of things, of course, but indicating that they are growing in a calculated way, and those marketing dollars that they've been spending are put to good use because they're actually getting a lot of conversion on the e-commerce front. And looking ahead, Trent, the company wants to build out their travel retail division. You'll see outlets in airports and the like. They'll continue to build these out along with another 20 to 24 licensed stores in the next few months. Our main concern is that the company will torpedo the progress of Bath & Body Works to basically subsidize a rapidly falling brand in Victoria's Secret. As long as L Brands can continue to innovate and pour resources into Bath & Body, they will see a long-term benefit as a company overall. And this is, again, in our opinion, but it really bears out in the numbers, just killing it on all fronts.
And now to our number one retailer of 2019, it's Costco. Costco is a rare retailer like Cato, for example, that reports sales numbers monthly. In 2019, they did not disappoint in any given month. As we've talked about repeatedly on the podcast, very difficult for mature retailers to see massive jumps in comps and revenue year over year. But for Costco, these jumps have just been the status quo. And it gets back to what Leighton was talking about with the stack for Bath & Body Works. You could look at Costco and say, well, their growth is slowing. To have the growth that they had this last year on top of comps that they've had really for the last 5 to 6 years, incredible for the company. They ended the year with 546 warehouses in the U.S. That's up from 535 in February. So they opened 11 new warehouses. Slow and steady store count growth continues to be their MO. New stores continue to perform well to the point where they're looking to open 20 more warehouses in 2020, many of them coming in the middle of the calendar year. One of their largest initiatives over the last 2 years is building out their e-commerce platform. We'll discuss those numbers in a moment. Now, when we talk about Costco, we always talk about the importance of membership fee income, and that, too, continues to increase by a substantial margin, sits at over 6% higher than where it was a year ago at this time. Renewal rates also continue to be strong, over 90% renewal rates in the U.S. They now have 99.9 million total cardholders. That's going to likely eclipse 100 million in the next month or so if it hasn't already. Also, their executive membership level, that's that, again, top membership level that they're offering, that's been picking up steam. By the end of this year, they were seeing an increase of 48,000 executive memberships per week. So we're not just talking about those base level memberships. We're talking about those memberships where Costco is capitalizing on that money up front. That's money in hand that they are getting from their customers. Although some media outlets reported their margins on fresh foods to be decreasing during their last earnings call, their margins actually just decreasing as a result of a new Nebraska poultry plant that they recently opened to ensure ample product supply and, in turn, deleverage their dependence on suppliers. Otherwise, margins in fresh foods remain steady. So it's a good thing that they're building this new poultry plant because, again, needed to take away that dependence on suppliers, going to have more of that coming in-house, can control more of the process, vertical integration there. But you're seeing rising margins across the board elsewhere. Hard lines, soft lines, food, sundries, all of that. And aside from their retail operations, they are killing it in their adjacent services. Their optical services, tire shop, hearing aids, all continued to gather momentum into 2020. A lot of other subtle changes throughout their store network also seem to be aimed at providing better throughput at the front end. Leighton has noticed, for example, big time increase in self-checkouts in stores, wider lanes, simplified product lookup access, all of that making it easier on what can be a very crowded front end when you see those sales numbers going up at Costco. Keeping stores clean and staffed while still competing aggressively on retail wages. They have long been known as one of the better payers to retail workers in the industry. And when we talk about the numbers, Costco continues to stack those positive comp leaps year over year. It continued with their most recent quarter, which is quarter one of fiscal 2020. Excluding gasoline impacts, their U.S. same-store sales popped another 5%. This came after full-year same-store sales increases of 6.4% from fiscal year 2019, following high single-digit jumps in fiscal year 2018. E-commerce sales also showcased a significant jump in the last year. Sales up 23.3% over fiscal year 2018 when you look at 2019. However, there is one potential warning light on the dashboard. Might be that those e-commerce sales were up less than 6% during the first quarter of fiscal year 2020. That coming in their most recent earnings report. Anxious to see where they fall for the holiday season. Now, as far as net sales for the last full fiscal year are concerned, they jumped 7.9%, 5.6% in the most recent quarter. However, the most notable number from Costco happens to be their net income. Despite lower than usual growth in the most recent quarter, Costco still saw an increase of over 10% in net income, meaning that they're managing to capitalize on that margin growth we mentioned earlier. In the prior year, their net income saw a whopping 17% increase, prior fiscal year, I should say, over fiscal year 2018. So we're looking at fiscal year 2019, 17% over fiscal 2018. So with those type of numbers, you can see why they're number one on our list. Also note, and we didn't really factor this in when we were making the list, but their share price up from around the $200 mark on January 4th of 2019 to over $294 as of recording the podcast here on December 29th. So Costco, congratulations, you're number one this year. They've been in our top 5 several times in years past. The first time they are topping the list.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead, and here we've got a whole decade to look ahead to if we want. So both Leighton and I are focused on remodeling type stories. I'll go first, and I'm looking at Walmart. Again, just missed our list of the top 5 retailers of 2019, but they are continuing to pour resources into their brick and mortar stores, and they're doing so now by hiring specific remodel associates. Now, in the past, as was pointed out in an article on Retail Wire by Tom Ryan, they've usually hired just a group of temp associates. Usually it's a 12-week turnaround, can be more, can be less. And what Walmart's found is that's placed too much pressure on store managers. So what they've been doing is they've hired more than 1,000 associates over the last year for these remodel teams in certain markets throughout the country. They're looking to hire 400 more to cover 15 total markets in early 2020. Now, the idea behind these teams is to finish around 100 remodels total and participate in other special projects that the retailer has going on. Additionally, these teams will not only be just resetting and converting planograms, they'll also be helping out with customers. As customers come into the store, maybe go to where their, let's say, favorite cereal had been located and is no longer there. These remodel associates are specifically supposed to help customers find that product and adjust to the new layout. The reason I'm looking ahead is to see if this new platform for the remodels is going to be effective for Walmart, or at least more effective than the temp way. Hard to think that it wouldn't be. I think this is a good move for Walmart, especially since they are doing massive amounts of remodels across multiple markets in the U.S. This is a good plan because you've got the same crew basically hopping in and doing one store at a time with the remodels. I like the idea. Again, time will tell, as we say with all the looking ahead stories, but I'm really looking ahead to see how Walmart can convert these remodels in 2020. Obviously, looking to make the stores easier and flow better for customers going into the stores, but also take advantage of all the e-commerce options that Walmart has, the buy online, pickup in store options, the curbside pickup options, and you're going to see the remodels really focus on this and kind of push that towards the front of what they're doing. But Leighton, I understand you're going to take it a little bit to the food side with a restaurant, really fast casual place that you visited this week.
Yeah, speaking of the last 10 years, over the last few, we did have another podcast called the Food Focus Podcast. So I'm going to be throwing it back to there. We had a segment called What We Ate. So occasionally on the Retail Focus Podcast, we talk about a retailer we went to. On the Food Focus Podcast, a now defunct podcast, we would talk about a recent restaurant that we visited, a QSR or an FSR. I recently visited a Newport Beach, California Chipotle, and the reason was I was hungry. I wanted Chipotle. I wanted something to eat. Little did I know this was one of the new locations that Chipotle is really trying to push out there, and it has a few new initiatives behind it. So some subtle changes and some larger, more drastic changes. So first, they had some different, slightly more spacious layout, a little bit different of a color scheme. Generally the same, though. They did have more space for the customers to eat their food. They had 2 different burrito lines, one for the customers that were coming in store, one for delivery or pickup. A pretty logical thing, but something that I was telling Trent before recording, it's taken a while to really push out. But you see now that they have these large screens for their employees to use now instead of a tiny receipt to fulfill those online orders or pickup orders. They used to work off of that little receipt. Now they work off these large 19-inch monitors behind the in-store burrito line. So I think that is very interesting. It's going to increase throughput because no longer are you going to be having associates getting in the way of the orders that are currently in process for those customers that are in the store wanting their food right then and there. And you look, Trent, not only more room in the back half of the store where you have the associates working and preparing food, but also generally a much cleaner, brighter, open environment. They're utilizing very high wattage fluorescent lights and LEDs throughout the store. Also, they have beverages in front now, so they have beverages right before the register instead of in a stand-up cooler behind the associate where you check out. You're noticing already, according to some of the sales associates at this Chipotle location, that sales are increasing in that particular category. We're talking about iced tea, that sort of thing. Visibly brighter menu screens as well when you first come into the store. I think that's a very important thing to have transparency, not only with pricing, but the menu options, any specials, any seasonal additions that they have going on within those Chipotle locations. Extremely important to convey to those customers coming inside the store. So a better overall experience pretty much everywhere, Trent, everywhere that you can think of. And before recording this podcast, I'm thinking, how do I transfer that, my experience at Chipotle for a prehistoric What We Ate episode, to retail and how retail is going to evolve or change in the next few years? We're looking at the next decade. I think Chipotle has pretty much hit it on the head with finding the right things to tune in terms of those subtle basics. And if you look at a lot of the things that, for instance, Dollar General has been doing, Target, Walmart, all of their initiatives really speak to sort of the same strategy, wherein your customers coming into the store, they want a bright, clean layout. They want clear signage. They want their stores to be clean. They want their stores to be well-staffed. And I think that's what all of our retailers in the top 5 have been doing on a consistent basis. So really, this transformed looking ahead story is about whether or not those least performing retailers, or even the retailers that we did not even explicitly talk about on this edition of the podcast, whether they're going to be using those basics to tweak their business model and make the overall brick and mortar experience more enjoyable. While we talk about e-commerce on this podcast, the brick and mortar aspect of retail is still extremely important. The vast majority of sales still happen in the brick and mortar setting, whether it's people picking up online orders or whether it's the family perusing the local specials on the weekend. So I think it's extremely important for these retailers to try to take advantage of any initiative they can. And I think sometimes, Trent, getting back to the basics may be most important.
Very well put, and I couldn't have said it better myself. Well, that brings to a close this decade, this past year of the Retail Focus podcast. Excited for next year and what it'll bring for the podcast. Already have several awesome interviewees lined up for the show as well. A reminder once again, check us out, Instagram, Twitter, at Retail Podcast. We're putting pictures up on our Instagram as we get them from retailers throughout the country that Leighton and I visit. And we'll be back approximately 7 days from now. Everyone have a safe New Year.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.